In today's video, I'm going to show you how to calculate how much of your Social Security is taxable. It is actually a separate tax code. It's only going to take us about 1 hour to go through. No, I'm kidding. It's not going to take us 1 hour. It's actually pretty easy, and I'm going to walk you through everything. I'm Raul Shah. I'm the CEO of DocShah Financial. We are a wealth management practice that works with retirees and pre-retirees on helping them pay much less in tax than they need to. We use a lot of advanced tax planning strategies. The slides you're viewing are from my retirement planning course that I teach at Johns Hopkins University, which is also my alma mater. So let's go ahead and jump right in here. So the first thing you're going to see is we need to calculate our provisional income. You see, people hear that the Social Security tax rate is 0 or 50% or 85%. Guys, these are not brackets, okay? So it's not like 85% of your Social Security is being sent away for taxes. That's not how it works.
This is your lunch. Now, you should be able to do whatever you want to with this, right? But here I come, the government, and I get to take 40% of your lunch.
Once we see the following table, it'll be very simple and easy to understand, but that's something I just wanted to mention just right off the bat. So we're going to calculate our provisional income. So step one, we're going to assume two things. We're going to assume that you're Bill and you're married to Mary Ann or vice versa, and your Social Security is $72,000. Okay, so essentially I'm just saying that you as Mary Ann or Bill make $3,000 a month from Social Security, and then the other spouse also makes $3,000 a month from Social Security, so $6,000 a month times 12, $72,000 in Social Security. I'm also going to assume that your RMD for the year is $75,000 roughly. Remember, RMDs are required minimum distributions. So in your tax deferred accounts, the IRS comes knocking eventually and they say, hey, you got to pull money out of those accounts because we want to ultimately collect our tax revenue that we've been waiting for 30 years while you have just been deferring to no end. So RMDs are those forced withdrawals. Again, these are just two examples that I drummed up here. $72,000 in Social Security, $75,472 in RMDs. Now combined, the total income is $147,472. Now, this total income is not what your total taxable income is. We have to actually go through the process here, and I'm going to show you what that looks like in just a second. But remember, step one, we have to calculate our provisional income. So in order to do that, we're going to take our AGI excluding Social Security, that is our adjusted gross income. That's $75,472, because remember, we're just taking our RMD, that's our only income in this example, and we're going to exclude Social Security. We don't have any tax-exempt interest, so I'm going to keep that as 0. Tax-exempt interest would be like if you own a municipal bond, right, like a state or locally issued bond, they pay interest that is tax-free, so you'd have to include that interest here. That doesn't mean the interest is taxable. Again, you'll see in just a second. We then have to take half of our Social Security benefits and add that into the mix, and that's ultimately going to give us our provisional income. Now, the IRS uses this number to determine how much of our Social Security benefits are taxable. So what does that mean? Well, let's take a look at the next slide here. Step 2 is calculate Social Security tax. Well, let's take a look at the IRS's provisional income thresholds for married filing jointly in 2026. The brackets are as follows. If your taxable income is less than $32,000, 0% of your Social Security benefits are taxable. From taxable income levels of $32,000 to $44,000, 50% of those Social Security benefits are taxable. And greater than $44,000, well, up to 85% of your Social Security will be taxable. So let's go ahead and take our provisional income and filter that through all of these three brackets. So the first $32,000 of our $111,000 is going to be subject to 0% tax for Social Security. So the total taxable security is going to be $0. Now, the next $12,000 that fills up this bracket, right, 32 to 44, 50% of that is going to be taxable for Social Security. So that's $6,000, right? 50% times $12,000. Now, anything above $44,000 up to 85% is taxable. So as you can see here, we have $67,472. Right, combine all of these equal our provisional income from the slide before. Now, 85% of $67,472 is $57,352. So when we add up all of these numbers, we wind up with $63,352. So this is our potential taxable Social Security. I say potential because there's one more step we need to calculate. Since 63,352 is more than 85% of their total Social Security, which was 72,000, we actually only take up to the 85% cap. That means that 85% times 72,000 or $61,200 is Bill and Marianne's taxable portion of Social Security. So remember, if this number, 63,000, was less than $61,200, that would be your taxable Social Security. The taxable Social Security is capped at 85%. So now let's take a look at the next slide and actually calculate the taxes that you will owe. So step 3, we're going to calculate our adjusted gross income, our taxable income, and then ultimately our tax due. So step 1, adjusted gross income. We're going to take our required minimum distribution, that's $75,472, and we're only going to take the taxable part of our Social Security. So not all of our Social Security, right? Not all of that $72,000 is taxable. It's capped at 85%. So in this case, it's $61,200. Our total adjusted gross income is therefore $136,672. Now, this is not the income that we're taxed on because remember, we get to claim deductions. Now in 2026, we have a standard deduction for married filing jointly of $32,200. We also have new senior deductions for those 65 and over up to $15,300. So our total deductions are $47,500. Deductions mean that we are going to deduct them from our adjusted gross income to figure out what our taxable income is going to be. Now, our total taxable income, that's the next step. We take our adjusted gross income, we less our deductions, and that gives us our total taxable income of $89,172. Now, we're going to take that number and we're going to filter it through the married filing jointly tax brackets. These tax brackets that you're seeing here at the bottom are different than the IRS provisional income thresholds that we use to calculate how much of our Social Security is taxable. I know it's a bit confusing, but just hang with me, we're almost at the finish line. We now know that our taxable income is $89,172. So we're going to go ahead and take a look at our federal income tax. So our first $24,800 is going to be taxed at 10%. That means that the taxes due are $2,480. Now the next tax bracket is the 12% bracket, and based on Bill and Marianne's income, $64,372 fall into that tax bracket. So we just take that number times 12%, and that gives us how much our taxes are for that tax bracket, which is $7,725. Now we simply add these two numbers together, and we get $10,205 in total taxes due. That is an 11.4 effective tax rate, and that is ultimately the tax that Bill and Marianne will owe on their income for 2026. So that's how you calculate how much of your Social Security is taxable, and ultimately how much of your total income is taxable and what tax rate and the amount of tax that you'll pay. So I hope you enjoyed this video. If you're looking for comprehensive wealth management solutions so that you don't have to bother through all this stuff, shoot me an email, raul@DocShahFinancial.com. I'd love to hear from you and see how I can help. I love working with pre-retirees and retirees on advanced tax planning strategies. There's lots of things that we can do here to mitigate the amount of tax that you'll pay. And I hope that I'll hear from you soon. Otherwise, see you in the next video.